My newly appointed deputy is passing out these index cards. So if you put your name and phone number and email address, I am going to give them to one of my newest employees in Puerto Rico, which is where my asset management company is now based, Euro Pacific Asset Management. We are pending registration here in Canada with VRIC. And I mean, these guys, I think, are probably worse than the SEC. It has taken me forever to get approved. This process has been going on for well over a year. Maybe it's even 2, but it's almost like any day, any day. I mean, I've given them all the information that they need. I mean, I was hoping that by the time I got here, I would already be approved, but they're still dragging their feet. But hopefully sometime very, very soon, I will be a Canadian registered RIA. I've been a US registered RIA for a long time. But when I get registered, all of my mutual funds, I have 5 funds in my family, all of them will be purchasable in Canada through any brokerage platform. You'll be able to go in there and buy any of my funds. Including in particular, relevant to this conference is my gold fund. I have a gold fund that is managed by Adrian Day. He's also a speaker here at this conference. Maybe he's here. I don't know if he's here. If he is, he can take a bow. He's done a great job managing the fund for us. We have 5 stars in Morningstar. I actually got a plaque from Lipper because we had the #1 gold fund for 5 years, ended December 2018, and the 3 years that ended that time period. And that was the whole time we had the fund. So we had it for 5 years and we were #1. So we got a great portfolio of gold stocks, but Canadians have not been able to invest. So that should change relatively soon as we get approved. And we also are going to be accepting Canadian accounts. I have been rejecting Canadian accounts for years because we weren't registered there. I don't have to register in Europe or, other countries. And, we have a lot of international clients, but we haven't been able to take any Canadians. We've been turning them down. But once I get registered, Euro Pacific Asset Management will be directly opening up Canadian accounts, so you can put your equivalent, I forget what you call the Canadian IRAs, but we could do those, and we'll be just like any other Canadian investment advisor, except we're based in Puerto Rico. So fill out these cards, and as soon as we're registered, you'll be #1 at the top of our list. I do have thousands and thousands of Canadians that ultimately we need to get back to, but these cards will put you to the top of the queue as far as getting accounts set up, whether it's my funds or a separately managed account. So anyway, let me get into my talk now that I guess it's time to start. And I will collect these when the talk is over. If you have questions though for me, save them for tomorrow. I'll be at my booth. Actually, it's the Gold Money and Monet booth. I'll be there most of the day. I haven't had anything to eat today other than breakfast, and I want to go and watch the rest of the football game. So I don't want to hang around, but I'll be here all day tomorrow. I have a panel in the morning, and then I have like a closing panel at the end of the day. So I'll be at that Monet Gold Money booth so I can answer any questions, and I'll try to collect these cards though when I'm finished talking, but if I forget to take it, just drop it by the booth. So anyway, the opportunities now to profit from what is going to be going down over the next several years, I think are tremendous. As I said earlier in my talk today, the Fed is back to cutting rates and back to quantitative easing, right? Whether they want to deny it or not, the facts speak for themselves. They're doing quantitative easing again. And they're not doing it again because it worked so well the last time. They're doing it again because it failed. If it worked, they wouldn't have to do it again. But the reason it failed is because it was inevitable, right? If you are a drug addict, the solution to the problem is not to take more drugs. There's no way that you're going to kick the habit by taking even more of the drugs that you're addicted to. But that's exactly what the central banks did. We had a debt problem because we had too much debt and interest rates were too low. And the government solution was, well, let's go deeper into debt by keeping rates even lower. So they took an addict and they increased the level of the addiction. And what the key was, and the reason that the last decade or more, or not quite more, maybe 5 to 10 years, the reason that they played out the way they did, and of course, looking back on the last 10 years, most people probably wouldn't have thought that it would go this way back in 2010. That the US dollar, that the US stock market would be the best place to be in the aftermath of the 2008 financial crisis. But with the benefit of hindsight, it was. But the key was the belief, the widely held belief, that the central bank's policies, particularly the Fed's policy, actually worked. And that people like me, who were warning about inflation, warning about the dangers of quantitative easing and artificially low interest rates, that we had been completely discredited and completely proven wrong. That everything was fine, that the economy was in great shape thanks to the Fed, and that removing the accommodation was just a done deal, right? All we had to do was normalize interest rates, shrink the balance sheet, and everything was going to be great. That's what everybody believed. And it was that belief, that perception, that kept everything going. Well, that belief was shattered. Everybody is now coming to the conclusion that we're in this for the duration, that the Federal Reserve is going to be doing QE excuse me, indefinitely, and that interest rates are never going to return to normal, that they are going to be artificially low forever. And that is impossible. That can't happen. Now, right now, the markets are not really coming to terms with that. They just think, well, it's okay, right? QE was good for the markets. It was good for the economy. Artificially low interest rates have been good, so it'll be good in the future. The only reason that it appeared that it was good was because it was believed that it was temporary and reversible. It wouldn't have been so good had people known from the beginning that this is where we were going to be, that the Fed was just talking, that it was bluffing, that it had no ability to normalize rates, that there was no exit strategy. So now the markets are going to discover this, because as the dollar starts to fall, and it will fall, it should have fallen this year, but it didn't. I mean, it fell in terms of gold. Gold had a strong year in 2019, but the US dollar kind of held water, treaded water rather, against other fiat currencies, despite the fact that we did the about face on interest rates and QE. But the dollar's not out of the woods. The dollar is going to fall. It has to. And inflation, or at least the way it's measured by the CPI, is going to rise, right? I mean, we're right now at around 2%, which supposedly is the ceiling, but that's now the floor. But inflation is going to pick up. And as the dollar starts to fall, of course, that's going to put even more upward pressure on prices, commodity prices, a lot of the things that we import. And this is going to be like a snowball kind of rolling down a hill. And as it rolls down, it gets bigger and bigger and bigger, and it gathers momentum, and it becomes much more destructive as it becomes, this huge ball that starts crushing everything in its path. That's where we're headed. Because once everybody knows that the Fed has no ability to control inflation, has no ability to raise interest rates or shrink its balance sheet, that's the end of it. Right? Because people were willing to hold the dollar so long as they believed that the Fed had the ability to defend its purchasing power. Well, not only does it no longer have the ability to do that, it doesn't even have the desire to do that. It doesn't even pretend that it wants to do that. The central banks, not just the Fed, but the Fed is saying, we want inflation, 2% a year is a minimum. We want more. So they're telling you that you're guaranteed to lose if you are going to hold dollars. So once this thing gets started, it's going to implode. And this means a lot, because once the U.S. loses control of the dollar, they've lost control of everything. Because the ability to artificially suppress interest rates the key to that is the dollar. The world has to want the dollar, because they have to create dollars to buy treasuries. That's how they suppress interest rates. That's how they enable larger deficits. That's how they enable corporations to keep on going deeper into debt to stay afloat, even though they don't have any profits. Look at all these U.S. businesses that don't generate profits. How do they stay in business? Because they can keep on borrowing money, or they can keep on tapping into the equity markets for capital. But why is capital so cheap for money-losing companies? Because the Fed is artificially suppressing interest rates. It's almost ironic that by creating inflation and printing money, they're actually helping to keep consumer prices down, because they enable companies to keep selling products at a loss because they can tap into these markets. But they can't do this indefinitely, because once the markets lose confidence in the dollar, well, then the Fed just can't keep monetizing the debt anymore, because they're creating money that nobody wants. They can prop up the bond market only so long as the dollar doesn't tank. But once the dollar starts falling, then the party is over. And that is where we're headed, right? And the opportunities, obviously, to make money here are pretty obvious, right? Gold is going to go through the roof in a dollar crisis. Because once the dollar starts to fall and it's down for the count, the dollar is going to lose its status as the reserve currency of the world. And that has profound implications, not only for the United States, but for the rest of the world. Now, for the United States, the implications in the short run are very bad. For the rest of the world, it's actually good. It may be a little disruptive, but it's actually a good thing, because America has benefited from this status to the detriment of everybody else, because we've been able to live beyond our means, and that means the world has made that possible by subsidizing excess U.S. consumption and excess U.S. borrowing. So this whole thing is going to come to an end as the dollar starts to fall. And of course, as I mentioned earlier, it's happening at a very bad time politically. Everything's going to get blamed on capitalism, on free markets, on tax cuts, on deregulation. And as this whole thing unravels, Americans are going to look to government and socialism and more central banking, more money printing as the solutions to the problems that we're going to be finally experiencing the consequences of. And I think it's also interesting, if you look at the markets, right? The price of gold, since it bottomed out in December of 2015, price of gold is up by 50% in the last 4 years. 50% gain in the price of gold. Americans couldn't care less about a 50% gain in the price of gold, because the S&P has gone up more. Maybe the S&P has gone up 70%. But if you look at all the other foreign markets, they haven't done 50% in the last 4 years. The US market has. But gold has beaten just about every other stock market. Also, if you look at the price of gold, even though the price of gold has moved up 50% in US dollars, it's not at a record high in US dollars. But it's at a record high in just about every other currency. It's at a record high in Canadian dollars. That's why if you look at sales, the Perth Mint has a physical gold business. And they just had a record year in 2019. Sold more physical gold coins than they've ever sold. The US Mint just had a record year in the other direction. They had the worst year they've ever had. So the whole world is buying gold except for Americans. And I know that from personal experience, because I have a gold company, Schiff Gold, and most of our customers are Americans, and we've had a bad year. We've had many bad years, and it's not just me. I mean, we're actually gaining share. The wholesalers are telling me that I'm doing better than my competition, that my sales are not off as much as a lot of other people's sales. But if gold was able to do this well over the last 4 years, with a rising dollar and with a rising U.S. stock market, that is not the most conducive environment for gold. If gold can do this well when the U.S. dollar is rising, imagine what's going to happen to gold when the U.S. dollar is falling. Because gold and the dollar compete with one another. Because gold is a potential replacement for the dollar as a reserve. And when a lot of people start to think about this whole idea of the dollar losing its reserve currency status, they always think in terms of, well, what currency could take its place? And then they just assume that the dollar is going to reign supreme forever. Because it can't They can't imagine the euro replacing the dollar with all the problems in the Eurozone. They can't imagine it's going to be the yen with all the problems in Japan, or the Chinese RMB with all the problems there. So what else could it be, right? Well, they're overlooking the obvious choice, and that is gold. Gold was the primary monetary reserve before it became the dollar. It wasn't the pound sterling. It wasn't like the pound was the reserve. The gold was the reserve for everything. And America took the world off the gold standard because we had all the gold, and the dollar was not only backed by gold, but was convertible on demand into gold. The dollar was as good as gold. At least that's what we told everybody until we screwed them, right? And defaulted on our commitment. In 1971, we told everybody, we're not going to give you any real money for your dollars. It's just monopoly money now. And the dollar was marked down substantially during the 70s, but then it, kind of found a floor, and it continued to be the reserve. And that's what enabled the explosion of debt in the United States. We could create money. It's like writing checks that nobody ever cashes. How well could you live if you had a checkbook and you could write as many checks as you wanted, and you didn't even have to have any money in the bank because nobody cashed those checks. And nobody even cared that you didn't have any money in the bank. They kept taking them, right? So we built up this whole phony economy with these bum checks. But when the dollar loses its reserve status, this whole phony economy comes tumbling down, and this has got some profound implications. But if gold is going to get remonetized, which it is going to, right, all the world's fiat currencies are going to go back to being legitimate currencies, right? Because right now, you have one fiat currency backed by another fiat currency. Well, how do you back the euro with the dollar if the dollar itself is backed by nothing? Right? You have to back it with something. And central banks, and that's why they're buying. There are a lot of smart central banks that continue to buy gold. They are preparing for the day that they need that gold to give value to their paper so that they don't have a complete collapse of confidence. Because all this is based on confidence. Right? And if the confidence goes, then all the purchasing power goes. So central banks are getting ready. And so the price of gold is going to go way up. It's not just going to 2,000, it's going much higher. And you can see that if you look at all the assets, look at this global stock market, look at global GDP, look at all these other financial assets, and then look at the price of gold. And you can see that all these assets are overpriced in terms of gold, right? Gold is a very honest way to measure asset prices, right? You can't really measure them in dollars or euros or yen, because you don't have a stable ruler, because the currencies keep losing value, they keep creating them. But gold is very stable, and you can measure value over time in terms of ounces of gold. And you could look at the bubbles that have been blown by central banks, and there's only two ways that they can be resolved. The price of everything else comes crashing down, or the price of gold goes up. And the path of least resistance politically is for the price of gold to go up, because the alternative is, a financial crisis like 2008, only much, much worse, and with no bailouts. Now, no politicians have the stomach for that. They're not going to swallow that kind of medicine. So they're all going to turn to inflation. That's the easy way out. That's what politicians have been doing for years. The thing is, it never works, but that doesn't mean they're not going to try it. They just get backed into a corner, and they have no expedient alternative. And so we're going to have a paper collapse, and gold's going to go way up. And that's how we're going to have a monetary reset. And so it's not that we get widespread default on debts. That would be better. The debtors are going to be repaid in money that has very little value. So before that happens, you want to cash in all those paper claims, and you want to get real gold. Right? Who knows where the price is going to go? I used to predict $5,000 an ounce, and people like to say, "Oh, Peter, see, he was wrong." Look, I was predicting 1,000 when it was under 300. I did not expect that we would kick the can down the road for this last decade, so I did think we would have got to 5,000 sooner. But my upside target is now much higher, because the problem is so much bigger than it was in 2008, and the opportunity to maybe do the right thing is so much smaller. And so 10,000, 20,000, these kind of numbers are clearly not off the table for the price of gold, and of course that means the price of silver is going to be moving up even more. The best opportunity, though, I think, is going to be in the gold stocks. That's where you're going to see not only the 10 baggers, but the 50 baggers, 100 baggers. I mean, I think the amount of money that people are going to ultimately make in this space is going to be phenomenal. Because there is just no optimism really in this sector at all. I mean, other than the die-hard gold bugs. But from my vantage point, looking at professional investors, looking at the hedge fund community, looking at the big endowments or the pension funds, nobody is involved in gold stocks or even physical gold. It's the last thing on anybody's radar. In fact, I was watching this interview on CNBC, and I forget the name of the person who was interviewing. It was the CEO of Newmont Mining. And then all of a sudden she looked at Newmont Mining. She said, oh, stock was up 50% last year. Oh, did anybody know that? I had no idea. I wonder if I should put that on my screen and start to follow it. Like, people are clueless about what's going on in gold and silver. In fact, gold stocks beat the S&P 500 last year by about 35%. I think the S&P was up about 30%. Typical gold index, GDX, XAU, it was up 40%. It beat the S&P. Gold stocks have beat the S&P for the past 2 years. And I think for the past 4. So if you start counting January of 2016, you're better off in gold stocks than the NASDAQ even. Most people don't know that. But gold stocks aren't expensive. They're actually cheaper than they were when 2019 began. The S&P went up 30% last year, and S&P earnings went down 1%. So stocks are much more expensive, yet people are, want to buy them. Gold stocks, I said they went up about 40%. The earnings went up about 80%. So they're more expensive. I mean, they're cheaper. Gold stocks are cheaper, even though they went up. Now, year to date, so far in 2020, gold's up about 2.5%. Gold stocks are down more than that. In fact, at the end of last week, I think the GDXJ, which is the junior miners, was down 6%. That's a pretty big move, especially with gold being up. See, normally if gold's up 2%, you might expect those guys to be up 6%, not down 6%. In fact, I was curious, when was the last time we had a January where you had a rise in the price of gold and you had a falling gold stocks? When did that happen? The last time that happened was January of 2000. Not only was that 20 years ago, but what was happening in January of 2000? We were at the end of a 20-year bear market in gold. Gold was around $270, $280 an ounce. And the NASDAQ was at 5,000. That was the highest it had ever been, right? And it was the peak of the bubble. And in the next 2 years, the NASDAQ went down by 80%, and gold stocks started a 10-year run where they went up 10 times. And even today, 20 years later, the NASDAQ was at 5,000 in 2000. It's at 9,000 today. It's up by 80%. Gold is up more than 5-fold since that point in time. But the reason I think it's significant is because you have to go back to January of 2000 to find the same type of mentality where even though gold is going up and even though gold has done so well the last few years, people are still selling off the miners and nobody is buying these stocks. So I think we have a tremendous opportunity before people wake up and contemplate the significance of what just happened with the Fed and this reversal, and to understand what it means for the dollar, what it means for the bond market, what it means for the U.S. economy. And it has very negative implications there, but it has extremely positive implications for gold and gold miners. So anyway, I know I'm out of time. Again, fill out the cards. We have separately managed accounts that we're going to be running for Canadians, where I invest in not only gold mining stocks, but all sorts of dividend-paying stocks all around the world that I think are going to be a refuge from this crisis. Nations that I think are better positioned to weather the storm and prosper as you see this massive transition away from the U.S. To a lot of the emerging economies that are now going to be consuming what they produce and investing their own savings rather than squandering them in US dollars. So fill out those cards, and again, we have separately managed accounts also in gold stocks. So if you don't want to be in a mutual fund, we have separately managed accounts that Adrian Day is also managing. We'll be doing that for Canadians as well. And anyway, thanks everybody. I'm going to collect the cards. And remember, tomorrow I will be at the Gold Money and the Monet booth. By the way, if you want to check out my Gold Money cufflinks, these I bought from Monet, rather. These are my 24-karat gold cufflinks, which have done very, very well. Since I bought them, I could sell them for more than I paid for them. And meanwhile, I got a lot of use out of them. But you can check them out at my booth. Thanks.